Well, hello, everybody. Thank you so much, as always, for joining us today for our live FAQ Zoom to discuss our new investment opportunity. We're, of course, thrilled to have you with us. And today we are going to explore and dive into our newest investment opportunity, which is a high yield credit investment in the vibrant heart of Harlem, New York City. So this investment offering includes a robust downside protection. It includes mechanisms such as additional collateral from the borrower and also a personal guarantee. And as you all know, Astor's utmost importance is to ensure investor security. And it also boasts the appeal of being a senior secured first position bridge loan, which offers stability and favorable returns in an ever evolving market landscape that we are currently in. So before we dive in, let me please take a moment to introduce who we are, Astor Realty Capital. Astor, under the leadership of Joe Burko, has risen to the prominence as the current investor of a phenomenal $2.2 billion real estate portfolio that spans across 12 major US markets. We have redefined the industry standard with our consistent track record to our investors. We deliver exceptional results, and we have produced an impressive 21% average return to our investors to date, which is well above the industry average. So today, who's going to present the deal and give us an opportunity for a live Q&A is our CEO and founder, Joe Burko. Joe will be sharing his expertise as we dive into the opportunity today. He has over 25 years in the commercial real estate finance and investment banking industry. His achievements include founding Burko and Associates, which is the sister arm of our firm, a New York-based advisory company. His industry accolades, such as Power Broker by CoStar, and his tenure as an advisor to the New York State Real Estate Board from 2009 to 2018, attest to his unparalleled expertise in the commercial real estate industry. So as always, if you have any questions, please feel free to drop use the comment and the chat option below. We're very happy to unmute you. You can ask a question to Joe. So that's the whole point of this Zoom interactive. Let's answer those questions and get you as excited about this opportunity as we are. So on that note, Joe, do we have you with us? Let me remove myself from the screen. And let me highlight Joe 1 second.
So Laura, we may not have Joe just yet. I think he was having a little bit of an issue with the computer.
Right.
But I can start us off. I know you didn't introduce me, but my name is Andrew Milbank. For everyone that is joining us here, and thank you for joining us. I'm the director of investments at Astor. I have been with Joe for about 10 years now. Actually, I think March will be 10 years. So I've been along the path with him here at Astor. We've done, I think, a really good job, and I recognize a couple of the names in the chat from some past investments. So welcome to everybody. I can share a little bit about the investment to start, and then when Joe's available, he will jump in. We can go to the summary page. So for those that are, I've seen a little bit about the deal. This is a senior secured loan, so a first position lien. The safest position that you can be in on a real estate investment, or you're the first position, you're the first to get paid. You have foreclosure rights on an asset. You have the highest protection that you can have on an asset, right? So for those that are a little bit more familiar with that, the other options are preferred equity and regular equity, which has been a lot of what Astor has done to date. So you might be a little bit more used to that from us, but this is an area that we are aggressively pursuing today. It's something you'll see a bit more from us in the future, is the debt landscape. So the asset here is 311 West 121st Street. It is vacant land. It is a development site, just under 15,000 square feet. Okay. We are providing a first mortgage just under 1.3 million to the borrower. This is an individual, actually a family, I should say, that Joe Burko has known for quite some time. He knew the father, knows the father of the individual, and we know the individual as well. He's been actively involved in New York real estate for probably, I'd say, 15 years at this point. He's developed a couple other properties. Actually, one of the other properties that he has developed is some additional collateral that we have for this loan that secured our position just a little bit more, which we will get into in a bit. The reason for the loan is to replace actually some existing debt that Astor has placed on the asset in the past. We are refinancing that loan to provide liquidity to some prior investors, and we are replacing that with basically the same loan amount, just a little bit higher actually to account for some interest reserves. The rest of the closing costs, financing costs, etc., is being paid out of pocket by the borrower, which is actually a bit unusual. That's actually a very good thing, right? The borrower is putting some cash into the property, whereas most refinances do not have that happen. The business plan really is for him to get this to a stage that he is able to pursue the development of the asset. He would build a residential building, 15,000 square feet, just like he's done at some other sites. The reason that he needs our loan, right, and that he needed our loan in the past, is there is an adjoining project, 300 West 122nd Street. So basically the other side of it of him in the back. That is a large condo project that is completed. It's actually sold most of its units. And there's an easement that was granted from this property to that project, which needs to be removed. It is removed once that project receives its full certificate of occupancy, which at this point is really just a matter of time. As I said, the project is complete. It's received a temporary certificate of occupancy. Residential units have sold. People have been moving in, right? So it's really more of a bureaucratic process, if you will, for it to receive its full certificate of occupancy. Once that is obtained, the borrower is able to resume pre-development and bring this project to a state that he will be able to develop it. At which point, there's a number of ways that he can repay our loan. He can sell the site, he can build it himself, right? Take out a construction loan. We may provide that construction loan, right? We may upsize and provide the construction loan of our own. So there's a number of ways that he's able to take us out, which we like, right? We like that there's the optionality of exits, right? It's not just one way to exit, right? There's a number of ways that he is able to exit. A couple of things that we did to reduce the risk, right? Because at the end of the day, this is vacant land. As I mentioned at the beginning, it's not a cash flowing asset. There's nothing on the site now. One is a personal guarantee, right? So in the event that he defaults and we're not able to recover our full 1.29 million, we are able to pursue him personally to recoup the rest of that. So, whatever assets he has, we're able to go after him, right? The other is we have a pledge of 3 condo units that the borrower owns at 2280 Frederick Douglass Boulevard, which is also in Harlem, right? This site is, I should have mentioned at the beginning, West 121st Street is Central Harlem. This other asset is also in Central Harlem. So he built this. He's got 3 units there, 1 residential penthouse, and then 2 retail units. We have a pledge on those assets in the event that he sells them. Okay, so he owns 80% of that, and we have a 49% pledge, right? So that is actually worth, in the event that he sold all 3 of those assets, more than the loan amount. So it's a significant risk reduction, risk improvement, if you will, right, to the project. Okay, Joe, I see that you joined. Did you want to say hello?
Wonderful. First of all, I think you're doing a great job, Andrew. So thank you for that. You had a little bit of a technical difficulty with the computer, but please, you're on a roll, so please continue. And I'm gonna address maybe the questions as we go along. And thank you for all who are participating. A lot of friends are here and a lot of new faces. So
Sure.
please, the floor is
Yeah, so
yours.
let me just I'll just finish up on the first page here. So again, a nice thing about a loan, right, as opposed to a an equity investment that might see all the return at the end. This is a current pay investment, so we are able to pay out quarterly on the interest. That interest is reserved partially upfront and then partially as a future payment of the borrower. So we are able to pay out quarterly interest. You're going to see about 10% current pay on an annual basis, with the remaining 2% to accrue. So if this goes for 12 months, let's say, you'll see about a 12% total return, 12% annual. If it went for 18 months, you would see an 18% total return, which is still equates to that 12% on an annual basis. Okay. And then just to finalize, you have just kind of the summary page. We are looking to close pretty much right at the end of this month. The other loan matures in March, so we'd like to have everything lined up for the end of this month here, which we think will be very much achievable. Again, we have the previous loan, so from a legal perspective, we already have everything pretty much wrapped up. We'll do a couple little tweaks here and there, make sure that we're all secure, but that should be pretty good there. Any initial questions that folks have before maybe Joe wants to address any points?
I see somebody
see
asked a question in regards to the structure, and even though you've explained it, maybe go through another explanation of what's the current, what's the accrued, and what's the potential total.
Yes. So basically, and I understand that can be a little bit confusing. So in this example here on a $100,000 example, we're kind of taking the approach that we believe he'll be out of this within 12 months, but it's a 12-month loan with one 12-month extension. So over a 12 to 18-month timeline, you're looking at the annual return, right, in the lower left there of 12%, a total return, if this were over 18 months, of 18%, which still equates to that annualized 12%. Okay, so if you were to invest $100,000 and this went over 18 months, you would expect a little bit over 118,000 to be returned. Is that making a little bit more sense, I hope?
Okay, I see Susan has a question. Hi, Susan. Good to see you.
Hi, Joe. Hi, Andrew. Yeah,
Hello.
Andrew, if I understood you correctly, you said that the purpose for this loan was to replace a prior loan. That's correct?
Correct, yes.
So what happened with the funds in the first place that you need to borrow again? Were the funds not executed as they were intended?
No, they've been
Is it
executed.
for development?
No. We've entered this loan and had a 3-year option on it, because that was a period of time where the asset next door, the building next door, which has an easement on our property, was at the early stage of construction. So we gave it a 3-year, knowing that during the 3 years, they'll finish the construction, there will be a building. It's a condominium with over 100 units, and so the time was needed. The loan matured. And so we've reached the investors and said, look, the loan matures, the neighbor next door still needs time to obtain the certificate of occupancy, and we'll need to either extend or default the borrower, create a term default.
Mm-hmm.
And so we've negotiated better terms. We've reached an agreement to have an additional collateral, and we've bettered the position of our current investors. Right now, our investors are very happy. They're making very high returns, but it's been about 3 years. Now we're going on 3.5 years. So we've already asked our investors, are you okay to have a 6 months extension? Under the current circumstances, people said yes. Under the current loan terms, we don't have to continue extending, but we wish to extend. And so we have two options, either have the borrower go refinance somewhere else, find money somewhere else, or keep the loan on our books and extend. By doing so, by recapitalizing the loan or refinancing the loan, I'm assuming that a good chunk of our investors, or at least some of the investors, will elect to stay in the loan and continue going forward and collect the interest. and a good chunk of the investors will continue with us on other loans, or will move and do other investments as well. So that's the I don't want to force our investors to continue maintaining this thing. Those who wants to stay will stay. We already have indication of how many would like to stay, and some would like to use other things, use the proceeds for other things. And so that's what we have.
But
Yeah.
I'm sorry, Joe, I'm just trying to fully wrap my head around it. So
Sure.
the 311 West 121st Street is the building that provides the easement to the one on 122nd, correct?
No.
And it's
No,
the,
no. Let me repeat it, and I'll make it simple. We have a loan on a piece of property, a vacant land with a certain amount of air rights that has a certain amount of value. This particular property has an easement from a next door neighbor,
yes,
and the easement says, I will remove the easement once I'll finish my construction, build the building, sell the condos, and get a certificate of occupancy.
and they have not done that yet. Okay,
And
okay,
so
okay.
this-
It just, the
so
light
listen,
bulb just went
wait,
on.
so let me
Okay,
let me finish. No, let me finish, because I
Sorry.
don't want to leave maybe others confused.
okay, I apologize.
Okay, so that's the easement. We're in communication with the next door folks that have the easement. The easement prevents the owner of the current property to build until such time that there's a building next door with the units and are in a full certificate of occupancy. The building next door has been built. The units have been entirely sold. The certificate of occupancy at this stage is temporary. And so we're in communication with the folks next door, and once they'll receive a permanent certificate of occupancy, and we hope it will happen in 3 months, 6 months, 9 months, a year, they will release the easement and will allow our current borrower the option to build his own property.
Got it.
However, 1 second, please. However, as long as we have the easement, the value of the property is diminished. And so what we've done is we've collected additional collateral as additional measure that if something should happen with the property next door, we have additional collateral valued similarly, or in fact, a little bit above our current loan. So not only we have a first position on this property, we also have additional collateral to the tune of just 1.38 or something above. That's a little bit above our current loan. That is why to reduce any sort of risk. And that's essentially what's going on. So what should happen once the easement is removed? Once the easement is removed, then the current property owner will refinance us out with a less expensive loan, possibly go and start building his own project, do whatever he wishes to do. Meanwhile, the collateral, the additional collateral that Andrew referred to that appears on this package, Andrew, maybe you can go to that page. Meanwhile, the additional collateral gives us additional security. What's the additional security? We have a pledge of some of the interest, a portion of the interest, 1 page back. We have a pledge of a portion of the interest, and what we have over here, and that's the building over here. This is the inside of the apartments. These are penthouse units and a large 9,000 square feet retail restaurant unit and a community facility, okay, for the total of value of around $7 million. This is our assumption of value. We understand that the borrower thinks that the value is much greater, but this is our assumption of value. We have a partial collateral. The borrower owns 80% of the current additional collateral. He pledged 50% or 49% of what he currently owns, right? So what we've done is we looked at the collateral, understood what's the value of those assets, penthouse unit, a retail unit, and a community facility, removed away the current debt on the asset, which is about $3 million. The available proceeds will be, and you can see here, it says net proceeds, the numbers at the bottom, will be $3,545,000. The borrower's portion is 2.83. We have that portion as additional collateral, which is $1,389,000. I'm sorry not to complicate anybody, but what we have here is a first position mortgage a personal guarantee, and additional collateral. Now, recently he sold one of the units, one of the penthouse units, and he went for the price point that he assumed. The second penthouse unit A, is on the market that's being offered for sale right now. So while we're waiting for the removal of the easement, units are being sold on the market, and we're releasing a portion of our loan. So there's going to be a repayment of the loan. So we have a number of areas to get paid on the loan. That's essentially the conversation. The existing collateral, which we have a first position mortgage, a personal guarantee, which allows us to go after the borrower on a personal level and use assets, and an additional pledge on an asset that's about a block away that has our position valued at just about above the value of our loan, or the amount outstanding on our loan.
Joe, we also have a raised hand from Paul Matamoros.
Sure. How are you, Paul? Nice to meet you.
I'm doing well. Thank you, Joe, and Andrew, and Laura. Thank you for inviting me to this. Excuse me. I did go over the OM a bit. Excuse me. Is there a image that depicts the vacant land that you're talking about?
The image of the vacant land, if it's not here, then I'm happy to share it. It's a regular lot, 25 footer, 25 by 100, nestled between two buildings. One of them is a brand new condo building. The other one is almost adjacent to a brand new large condo building. So it's nothing special. It's just a piece of land, and depends on the way you trade those lands. They range in value. Here we go. So this is West Harlem. We're close to Columbia University. We're close to Apollo Theater. It's a fairly good part of Upper Manhattan. This is the lot. Right adjacent to it is a 25-footer condo building. Yes, if you can show the full angle. So that will be, if you're looking at the left, this is 313 West 121st. And that will be a similar property will be built on 311, which is our site. So you can get an idea of what we're looking at. Okay, so that's sort of like where the value is. Condo buildings today trade for, around $1,100 a square foot. Just somewhere on the line. Maybe the penthouse goes for a little bit more, but there's certainly a lot of value to achieve in those little sites. And so you have some side. I'm sorry.
I'm sorry, Joe. So yeah, it's pretty typical, even like in San Francisco, 25 by 100. Is there going to be a problem with the building to the right of that with those windows? I'm just wondering, not to get so deep into the gentleman, your clients.
Let's go to the visual again, and I'll answer your questions. Maybe it will be easier. So in New York, like in other cities as well, you're allowed to build until your lot line. So the windows can you get me more of the angle on the building on the left, the 313? No, just go a little bit, show me the side of the building. And so what you have, you're allowed to build until maximum on your lot, okay? Maximum on your lot. And so it's called lot line windows. And here we go. If you take a look at the newer building, the one that is indicated as 313, you see that the side of the building simply has no windows. And it was built this way because the developer knows that eventually somebody's going to build a building on the lot, and he's going to abut it against that building. And so if you were to open up the windows over there, those windows will be shut, right? Because those are called lot line windows, and there's no right for air, and there's no easement that prevents you from building all the way towards your lot. Now, sometimes in the older buildings, which is, let's say, a 309, as you can see to the right, you'll see that they have a different shape. It's called the dumbbell shape. The dumbbell shape, if you look from above, it's sort of like a dumbbell, where it's wider at the edges and narrower inside. You can see it better over here. It's not a perfect view, but those windows are also lot line windows. Somebody would build, it will almost touch them. However, the building is curved in, hence the dumbbell shape, right? So outer is wider, center is narrower, back is wider again. And so there was a different style of building. Obviously today, it's much more valuable to build to the full extent of the lot. But to answer your question in a quick answer, the answer is no. You're not going to have issues with the neighbors because you're allowed to build to the maximum width of your own lot.
Okay, thank you very much, Joe.
Sure. So if there's no more questions, we were happy to share with you this this video. Share with you,
So
share
there is a question from Hassan. I saw it was posted. He said, what kind of easement adjoining the development property, and what would be the value of the land if the easement could be removed?
So great, let's stay on this page. The easement essentially prevents the property owner, the landowner, from filing for any permits to build on his property so long that the larger building, the 100 condo unit building is being built, and until such time that the building doesn't receive a full certificate of occupancy. So again, the larger building, when we gave the loan, the building was under construction. At this stage, the building is fully built, nearly entirely or fully sold. Maybe there's a couple of units left. It's a gorgeous building. They have a temporary certificate of occupancy, and we're expecting the permanent certificate of occupancy fairly shortly. Now, fairly shortly, we don't know what it is. We don't know if it's months, or if it's 6 months, or if it's beyond that. Therefore, we've taken additional collateral. But let's go back. Removal of the easement. This analysis here shows you recent trades of similar properties within the immediate area. Subject property, 311 West 121st Street, is above. We have about 14,890 square feet buildable. If we go by the average, we'll say that this is an average, it will be an average trade, then we think that the value is 2,873,000, assuming the market is normal. Right now, the market is not great. But assuming under normal market conditions, not hot, not cold, the value of the asset, it will trade for about 2,873,000. How do we know it? We looked at 6 different sites in the immediate area that have traded in different times at normal market conditions. Again, these are not normal market conditions, and they trade anywhere from $150 all the way up to $238 per buildable square foot. So for an average of $193 per average per buildable foot. Applying the same average to our site, which as you can see here on top, so $193 times 14,890 buildable square feet, we believe the value is 2,873,000. What does it really mean? We have a loan of about $1.3 million, $1,290,000. Okay, so we're sort of like hovering below 40%, in fact, around 35, 37%. This is assuming a couple of things, assuming that we have the full air rights to be used according to an architect that looked at the site, has analyzed the site. We have the air rights, we have the 14,890, and assuming that market conditions are normal, not favorable, certainly not bad. I want to say that if today we had to put the building on the market, it's the lot on the market, obviously with the easement removed, I would say you're probably looking at 20% discount from that. And so question number one, do we have enough of a collateral to support $1,290,000? In our opinion, yes. Do we have enough of a collateral to cover ourselves should there be any issues with the easement? Let's assume the answer in our opinion is yes, because our collateral, our additional collateral is larger than our. If you were to say, to analyze the risk from a downside protected, then you would say, pretty much we're looking well, right? We have the land, we have the guarantee, and we have the additional collateral. So I think we're in a good position for the amount of risk that we're taking.
Joe, we have Mark Sirota who's raised his hand. Hi, Mark.
Hi, Laura. Joe, I have a quick question.
Hey, Mark.
How you doing? When you calculate the return, the 12% annual return, I think you always do, but I just want to ask, is that based on the investment and the investor participation fee?
Yes, that's always, yes, we always take into account. It's a great question, Mark. Thank you for asking. the question here is, when we do our calculation, every investor has an investor participation fee of about 3%. And so when we assume the returns on the investors, we take this additional expense to the investors into our calculation in order to achieve the real net annual return. And so over here, we're talking about 1% a month, 12% a year. And assuming we'll go by 18 months, then we're looking at 18%.
The reason I asked is if you look on slide 4, the projected investor returns where you have the $100,000 plus the $3,000, there's a footnote at the bottom, and maybe I'm misinterpreting it, but it says the net profit due to the investor does not include the investor participation fee. So I wasn't sure if that means something different or if you're selling yourself short by saying that in the footnote. I just wanted to make sure I understood the footnote.
Let me take a look at the footnote. Let's try to see if it's a mistake or if it's something that needs to be addressed.
At the very bottom there.
Okay.
I think we meant that as in the that the dollar amount itself would not be returned.
Yeah.
I could see where you get it's it could be a little confusing. We could maybe reword that for the future.
Okay.
Well, if someone puts, let's say if someone puts in $100,000 plus 3,
Yes.
put in $103,000. At the end, do they get back $103,000 plus a 12% return on $103,000?
No, so they get back $100,000. The $3,000 is capital that we use to keep the lights on, as we say, pay salaries, keep the investment going. The return of capital will be $100,000 plus $18,563. The total return, assuming everything combined, will give you the 12.01% return per year.
Okay, I get it.
We have a reduction here. In order to keep it at 1% a month or 12% a year, we made a little bit of a reduction on our fees. Typically, we take 25%. In this particular case, we dropped it to 17.5%. So once I calculate everything combined, you obviously an investor comes in with $103,000. After we take our fees, I'm doing the calculation based on your full amount of dollars. The $3,000 stays with us. Okay, so I'm assuming that you've invested $103,000, gotten $100,000 back, plus $18,563. Your total return is going to achieve 1201.
I saw that you were only taking 17.5%. All right, thanks, Jeff.
A little bit of a reduced. It's a little bit of a reduced fee in order to maintain a 12% return to the investors.
Thanks a lot.
Sure.
That is all questions for now, as I've been dropping in the chat.
So,
anyone,
so
Maria?
there's, yeah, sorry. So I saw previously Kat Alvarez. Hi, Kat. So she also had a question, but I don't see it anymore. She wanted to clarify it on, oh, here we go. Help me understand 10% paid quarterly versus 12% versus 17%.
I'm not quite sure what's the 17%.
So I think so. So basically, there's 10% paid current, meaning every quarter you're getting 2.5%, and then at maturity, the remaining 2% is paid. That's accruing. So on an annual basis, it's 12%, with 10% of that being paid, every quarter as income, and then 2% being paid at maturity. And the 17%, I assume that means the 18%, and that's the assumption that we made for total return if it were over an 18-month period, right? So 12% on the first year plus the 6% on the next 6 months. I confused myself a little bit there, so hopefully that that made sense to everybody.
Well, as we give anyone else an opportunity to absorb this and perhaps have some more questions, Joe, we do have some new investors on the line with us, so perhaps you can go into, and I'll share the appropriate screen, just go into a little bit about us, our track record. We always get the questions in advance of a Zoom. What have we done to date? What's our experience? So if you can just spend a little bit of time on that.
Sure. A pleasure.
One second whilst I share my screen. I apologize. start with that.
Start with that. Okay, sure. So for those of you who are new, we have a lot of existing investors here, and it's always warm and fuzzy to see everyone. My name is Joe Burko, as you can probably see in a bunch of different slides. I've been around the block in the real estate arena for about 28 years, started from New York City, as Laura might have mentioned earlier in the conversation. And started my career in investment sales, structure finance, representing private, public companies throughout New York City, also representing the state of New York for a good amount of time, for about 9 years, being nominated by the last two governors. We've done a lot of transactions, hundreds and hundreds of transactions over the years as advisors, sometime around 2020, 2014, 2015, early 2015. We've pivoted, and instead of keeping our position as advisors, we decided to put our money where our mouth is and start investing. We've opened the investment opportunity to friends and family, and that club, God bless, had grown word of mouth. And within a year or so, a year or two, we were teamed up by a public company from overseas who gave us a larger backing, larger capital backing. And so, in the last 7 years or so, started creating investments in various markets throughout the United States, major markets throughout the United States. We deploy capital in 3 different strategies. The first one is creating a joint venture partnerships. What we do is we study very well an area that we want to invest in because of growth of employment, growth in population, capital infusion, other externalities that we might be made aware of, and then focus very heavily. Look for a great partner in that location. Typically, our partners have experience either in construction or management of various real estate assets, and then we create joint venture partnerships. Typically, our partnership will be the larger check, maybe the 80% check within the project, and we'll go and embark on putting together a project. This is some good examples of some of the projects that we're involving throughout different locations, from Chicago to Miami, parts of Brooklyn, Manhattan, and so on. To date, we've invested in projects that are well over $2.25 billion, 3.6 million square feet. In our project, you'll find a lot of ground-up construction of various multifamily projects in various locations, some condo projects in very, very specific location that we feel good and comfortable about, and very selectively lifestyle hotels. Again, very, very selectively, the right type of brand, the right type of partner will be very comfortable to build hotel, but it just has to be perfectly right. A little bit of logistical centers, in fact, not enough. And that's essentially what it is. We managed today a little bit more than the number here. It's about $114 million. And that's our participation. So that's one way for us to invest. And whenever we invest in a project, we initially get the larger check. Our partners, our institutional partners, will commit the larger check, and then we'll kind of like, push aside about the last 10, 15, 20, 25% and offer it to what we call our friends and family. The friends and family, the check size is less important. If you're beginning in the investment and just learning to know about us, then we typically expect you to come in with a smaller check and get kind of like the comfort level as we move along. And so that's essentially our positions. That's joint venture partnerships that we invest in various projects. We come in, we build, we stabilize, we sell, we return the money to the investors. Other positions that we do is preferred equity positions. When we're unable to have the kind of control that's necessary for us, the project might be too big, or check size may be not enough to can maintain the control rights, then we do something called preferred equity. Preferred equity position essentially says we're going to reduce our risk by asking for our money to be returned prior to other investors' money. So let's say, for example, there's a $100 million loan. The bank obviously will get paid first. Let's assume the bank is $70 million. And from the $30 million of equity, maybe it will be 20%, maybe it will be $6 million. We'll cut a deal with the rest of the investors, and we'll say our $6 million, that is our institutional partners and our friends and family, $6 million, will have a priority of return. We'll see our money before anybody else gets paid, and it will come in with a coupon, typically a high double-digit coupon, somewhere in the teens. and sometimes creating a little bit of a bonus if certain conditions are met. The last type of investment that we do is investment in debt, very similar to the project that we're doing now. We come in and then we create a position where we are able to offer our investors. Also, we try to achieve double-digit return, anywhere from 10, 12, 13, 14% return, whatever we can. Obviously, the more secure the position is, the lower the return. It's always risk-adjusted return in everything that we do. And so we are relying on my expertise, about 28 years, and the expertise of our entire team, which is about a 65-year collective experience. Overall, as I said, we're about 3.6 million square feet of quality real estate across 7 major states, 12 major markets. Thank God, no losses. Like a lot of other funds and other real estate managers, we're struggling with the last couple of years of a tough economy, increase in interest rates, and drops in valuations, and still, we're holding very, very strong. Our average return throughout everything that we've done is roughly around 21%. And if I'll focus only on equity positions, I think it's probably going to be somewhere in the mid 20% return. That's essentially who we are. We have a strong philosophy that we don't enter a project if we don't have a way to exit it, right? So if we build condominiums, we always make sure that we have a plan B and that we're going to underwrite for rentals. If we are doing a loan and we think that there's going to be some risk with that loan, like in the case here, there's an easement, and with all good intention, what if? I always have to ask what if. Then we get for additional collateral. We always look for other areas to exit from a situation and return capital to our investors. Today, we have about 300 high net worth friends and family investors that invest with us pretty steadily. Not in every project, but many of them have created an amazing portfolio, and this is what we're looking for. We're looking for steady investors that are able to build themselves a good, healthy portfolio in investments that are long-term, 3 to 4 years, with an exit at the end. Some of them are cash flowing, and that's really who we are. If you'd like to have a longer conversation, we always love to meet new investors. I make it my business to get on the phone with almost everyone. I don't think that there's any exception of always get on the phone with new investors. Make sure I understand what you're looking for. What's your objectives? Are you looking for income? Are you looking to create diversification? What exactly, how can we help each other and how can we help you? And what we found over time, and that will be my last remarks, is that folks start with us, they enjoy the reporting. There's a lot of communication. You don't just send a check and hear back at the end after 2 years. There's a lot of communication with us. Laura will always reach out and give you, breaking news on a quarterly basis. Of course, we'll have a full report, but in between, there's always breaking news. There's always something that's going on. We make sure that we share with you whenever we go out to do a tour, asset tour, and things like this. There's going to be a lot of that communication. And I think that what makes us different is that we are accessible. I'm accessible, our team is accessible. And so, for us, it's personal. That's it. We'd love to see you among our investors, whether in this project or future projects as well. And I'd like to thank everyone for joining us this afternoon, and hope to speak to you and see you soon.
Joe, before I let you drop off, and we'll answer Paul's question, but thank you all, everybody. You've got the QR code there. You have my contact information in the chat. You have Joe's. Please reach us. We're available for any perhaps more private questions you would like to ask with Joe. And Paul, we will address your question now before you wrap up. But thank you so much, everyone else.
Okay, yes, I'll be brief. Thank you very much, Joe, for that description on your investment categories. I was wondering, when you said that you're very transparent, what type of platform do you use as far as investors having access to any of their records and seeing what's going on?
Great question. I will actually ask Laura to answer that, as she'll be the one who's taking the onboarding of new investors and so on. So Laura, please.
Yes, of course, of course. Paul, pleasure to meet you. Thank you so much for joining us.
Thank you.
So our investor software currently is via the AppFolio portal. And as you've been seeing, I've been sharing a QR code over the course of this webinar and a link. That is where you will go. If you are interested to proceed, you'll submit your information in there and that will grant you access to the portal. So not only will I onboard you via the portal, that will be, for me to get all of your KYC stuff, we'll sign documentation that way. And then moving forward, your portal is always up to date, is always live. So at any time, of course, I'm always here. Shoot me an email. I will reply at the later hours or on a Sunday, but you can also log into your portal. You'll see your live positions. You'll see your live distributions. And of course, for convenience, all of your tax documents, all of the reporting will be there. So when it comes tax time, you'll hopefully at that point, you'll be in a couple of projects with us. You'll be able to go into your portal, download everything, and super convenient.
Take care, everyone. Have a great evening, and hope to see you all soon. Take care.
Thank you all, everyone.
Thanks.
Have a good afternoon.
I know.